What's happening in tech? We said that the Nasdaq's down more than 5% this week. We're having the worst week in about 18 months, and the tech sector itself is off more than 7 on the week. What's going on with that trade?
Tech, I think, revealed its hand last week because NVIDIA had a good number, but it fell. So when stocks fall on good news, you know it's either a crowded trade or something bad could be coming. And then, of course, they've led the downside this week. I think it is part of this pull forward the seasonality because people want to de-risk, and tech is a big holding. But I think on the margin there could also be a political aspect to this. You know, Trump's probability of winning actually increased this week in the betting markets and in the polls. And I know investors think he'll be tough on China, which would be bad for semis. So I think part of this could be fears that a Trump gaining is bad for semis.
What if there's just too much priced into these stocks at this point? Valuations have gotten a little too rich, even if they're the greatest stocks in the world, which you've made the argument that, in fact, they are, that this is the place you want to be, maybe more than any other. And what if that's true and the multiples still don't make sense?
I think it's possible. In NVIDIA's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, NVIDIA's forward PE, was actually higher at the bottom of those drawdowns. You know, right now, NVIDIA's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes NVIDIA down to the 90s, but I think 2 years from now, that's really going to be a gift.
So when you look at all of these, are you a buyer on the dip? Are you urging people who read your research and listen to you here and elsewhere to do that?
We're close to that point because let's say we thought that there would be a 7 to 10%, the risk of a 7 to 10% drawdown between now and November. We're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September. So I think we're close to the point where, I wouldn't be a seller here, and I think if the lower range of the S&P's 5,400, 5,350, we're almost there now.
You think the move from August 5th to, let's say, September 5th was justified? Was it too much? Was it built on reality? What do you think?
It's hard to know. I know that there was panic that caused that 3-day drawdown, and the VIX spiked to 66, so we know that there was panic. But we also know there was a ton of cash on the sidelines already into August that was put to work. And I think part of this was a liquidity move because we know the yen was highly correlated with that move. And it's kind of happening again. The yen's turned strong, and it's been putting pressure on stocks.
Make the case for our viewers that 21 times earnings makes sense for the market. That's the current valuation. Everything could be great, and that could still be inflated. Maybe it's not. I don't know. Make the case that it's fine.
Well, I think there's a couple things for viewers. Number one, the S&P is at 21 times, but that's because of the Mag 7. The median S&P stock is at 16 times forward, which is not demanding considering the 10-year's at 3.7. The 10-year is trading at almost a 30 PE multiple. So when you buy a bond and you think that's safe, you're paying a 30 PE, and you can buy equities that are growing earnings 10% for 16 times earnings. I think stocks are a bargain here, especially in a rate-cutting cycle and with inflation falling.
So when you say stocks are a bargain here, you're talking about the 493? That they're the ones that you should be buying, even as we're asking ourselves, hey, is the economy a little slower than we think? Is the labor market weakening faster than we're willing to believe?
Yes. And I would say, number one, the 493 are attractive because the Fed is on an easing cycle. And if you look at something like small caps, the median PE in the Russell 2000 is 10 times earnings. You've got a huge margin of safety in small caps. I don't think tech is a sell here, but it probably is a source of funds if people are worried about seasonality. But do I think the Mag 7 is going to be lower by the end of this year? No, I think it's going to be higher, but it's just tough to know when the bottom is.
Well, the problem is tech is, to use again the word of Rick Reeder, recalibrating. But you don't feel comfortable going into these other areas over the last week because we have questions about the economy.
Yes.
That's the conundrum for investors. Do I buy the dip in tech, or is the re-rating still going to happen because the growth rates, albeit fabulous, are still a little bit slower than they were? And then can you really bank on the others if we're asking ourselves all these questions about the economy?
Scott, these are fair questions, and I know Rick is a very studious follower of markets, and he's pointed out credit spreads have been really stable and tight. That tells us that the growth fears is more of a narrative risk. You know, people who are hard landing folks have some ammunition, but I think the economy is tracking for a soft landing, and that means stocks are overreacting to what is seasonality, and so ultimately it's a buying opportunity.
Unless all of that is, as some would make the case, priced in. Like all of the good news is priced in. Soft landing's priced in, rate cuts are priced in. Maybe the market's even a little ahead of itself on the number of cuts and the totality that we're going to get. How do you respond to that?
I'd say that what you're describing is a major market top, and I know people are fearful this looks like 2007, but there's two things to keep in mind. The advanced decline line made an all-time high, which means there's basically zero probability the index has made an all-time high. And I'm almost positive the major market top has never happened with small caps trading at 10 times forward earnings.
All right. Before I open it up, you went small caps, I want to go small caps. Your big call that happened on this show, I don't remember how many months ago it was at this point, where small caps go 50% higher this year. Last time you were on, I pressed you on whether you still believe that. You didn't back down, and you said the back part of this year, which is now we're winding down, could still be robust for that trade. And you still believe that?
Yes, I believe it. Obviously, small caps have not followed, and they've actually been stuck in the mud. But earnings have been supportive. Small cap earnings grew 19% in Q2. They're set to grow almost 40% in Q3. That's fundamental acceleration. The PE is still 10.7 times forward. And let's keep in mind, last year, small caps moved 27% in less than 20 trading days. So I think that once the market's convinced of the Fed actually following through on the cuts, and they believe we're in a soft landing, and next week might give some confirmation, I think small caps do get the green light. Okay.
You tried to hedge a little bit heading into both NVIDIA and Broadcom, right? Talk to me about the trades that you made going in.
Yes, Scott, I think we had a good thesis last week that NVIDIA was going to be volatile. Option markets were indicating somewhere between a 9% move. You just never know if it's going to be up or down. It'd be a lot easier if you did. Same thing with Broadcom yesterday. Pretty heavy indication of an 8-9% move. So what we did yesterday with Broadcom is we wrote a covered call, only a 1-week expiration, so it'll expire next Friday. But the annualized premium that we brought in was 60%. Now, I realize that sounds crazy, and it's only because of the hyper volatility heading into earnings, but we brought in $1.73 yesterday. We wrote a covered call on Broadcom, incidentally, when we did the NVIDIA call last week. We brought in $1.25. So we closed that out yesterday, wrote another Broadcom call. It brings in about $3 in premium for the past 2 weeks. Now, granted, the stock's down a lot more, but we were able to hedge 20% of today's decline with those two option trades just within the past 2 weeks. So it worked out well for NVIDIA. It's worked out well for Broadcom. The stocks are trending down, so I think we want to be a little bit patient before we add to them. But I think that you'll get a buying opportunity. And we're seeing prices, Scott, similar to where we did at the at the jobs report last month when we saw the massive sell-off. So I feel like that would be a good entry point for people to buy the dip for sure.
So you're more of in the buy this market rather than beware it.
Yeah, we didn't buy anything today. It was a short week. It's the first week where people are back after the holidays. You get a lot more volume. So we wanted things to settle out. We were also very concerned about what the jobs report would look like, remembering what happened last month. I thought the numbers were good on the jobs report. The market selling off, I think, is more of a growth issue than a recession issue. Whether the Fed's going to cut 25 basis points or 50, a lot of uncertainty in the market there. But I think the opportunities, Broadcom's already back to where it was on that August 5th, August 7th low. NVIDIA isn't, but certainly it's getting closer. And yeah, I would be a buyer of the dip, Scott, and we will be.
All right, I hope you're all doing okay today and staying calm in this market. Today was a rough day across the board. The SPY finished the day down nearly 1.7%, and tech got absolutely smashed today with the triple Qs closing the day down nearly 2.7%. I'm going to talk about NVIDIA and the rest of the market in just a moment, but first I want to talk about Tesla. Listen, I will be completely honest with you. Today was brutal for Tesla. The stock closed the day down nearly 8.5%, wiping out most of the gains from the previous 2 days. Now I am still holding my position in TSLL, and I intend to follow through with exactly what I said in the video I posted on Monday. There are only two situations situations in which I sell this position. Either A, the robotaxi event is delayed again, and if that happens, I will sell this position immediately on that news. Or B, I will hold this position until sometime in early October. And so as long as the event is not delayed again, I intend to hold until early October. Today was rough though, I'm not going to lie. As far as I'm aware, we didn't get any Tesla-specific news today. So it appears that today's price action was due to the rest of the market freaking out and megacap tech as a whole trading lower today. I still think we could see momentum in Tesla return at some point between now and October 10th. The biggest risk to this swing trade is if the event is canceled again. And the second greatest risk to this trade is the rest of the market. And today the rest of the market was panicking. I'll talk about that more in a moment, but first let's look at NVIDIA's chart. So NVIDIA closed today down about 4%. Last week I told you we were trading below the 50 MA on the daily time frame, and I was looking for NVIDIA to trade lower and retest the support trend line that stretches back to January of this year. Then on Tuesday of this week, NVIDIA broke below the trend line. And I've been telling you that I'm looking for NVIDIA to gradually trade lower toward $90 per share. I've been saying this a lot this week, and I'm still looking for this to happen at some point in the days ahead. Of course, I don't know what the future holds, and I could be wrong. That being said, I'm looking for NVIDIA to retest historic support around $90 per share at some point in the coming days. I'm not saying this will happen immediately. It could be a number of days before this happens, and we could have some green days along the way. Ultimately, though, if NVIDIA reaches $90 per share or even dips lower into the 80s, then I think that would be a fantastic long-term buying opportunity in NVIDIA. NVIDIA's earnings were fine, and the market freaked out because NVIDIA's growth rate appears to be slowing. NVIDIA's growth rate did technically slow this quarter, but it's all because of the delay in Blackwell. Blackwell is delayed by about 3 months. Blackwell is supposed to ship in Q4, and NVIDIA expects roughly $3 billion from Blackwell in the first quarter that it ships. At NVIDIA's recent earnings report, the street was expecting Q3 guidance of $31.77 billion, and NVIDIA guided for $32.5 billion. If Blackwell had not been delayed by 3 months, then NVIDIA would have guided Q3 revenue higher by $3 billion. And therefore, the overall trend of NVIDIA's growth rate acceleration would have remained intact. It all comes down to the delay in Blackwell. This is important because it means we could potentially see NVIDIA's growth rate reaccelerate at some point in the future once Blackwell is shipping in volume. With this in mind, and considering that demand for NVIDIA's products is still enormous, I think $90 per share or even lower would be a great long-term buying opportunity in NVIDIA. Now let's talk about why the market traded lower today, because there are multiple reasons. So this morning we got a very important jobs report. I told you in yesterday's video that if the report was much worse than expected or much better than expected, then that would be bad for markets in the short term. The ideal scenario for this jobs report would have been for the report to come in line with expectations. The unemployment rate came in line with expectations, but non-farm payrolls did not. They came in at 142,000, over 10% lower than consensus estimates. On top of this, the Japanese yen moved higher today. As I mentioned back in August after the carry trade unwind situation, if we see the Japanese yen trade higher, there will be a problem of concern for U.S. markets. If the yen moves higher, then that puts pressure on firms who have borrowed money from the Bank of Japan and invested that money into U.S. stocks. So those were two important factors today, a less than great jobs report and a rising yen. And of course, on top of that, we also have concerns about the upcoming election and the next FOMC meeting on September 18th. Rate futures traders could not make up their minds earlier today as they kept flip-flopping between betting on a 25 basis point cut and a 50 basis point cut at the Fed's September meeting. So all of these factors combined with a rising volatility index today weighed down on the market. Looking ahead to next week, we have an Apple event on Monday, a presidential debate on Tuesday, CPI on Wednesday, and then we get initial jobless claims and PPI on Thursday. So a lot is happening next week. Really quick, let me summarize what I've said in this video. I'm still in the Tesla swing trade, and I think there is more upside ahead as long as the robotaxi event is not delayed again, and as long as the market can simply remain calm. As for NVIDIA, I'm looking for the stock to trade lower toward historic support around $90 per share, but this may take multiple days, and we may have some green days along the way. And as for the overall market, traders are struggling to make up their minds as they grapple with Fed rate cuts, the upcoming election, the rise in the Japanese yen, less than ideal economic data, etc. And next week, we have some important events. The Apple event on Monday and the presidential debate on Tuesday. And then we get more important economic data on Wednesday and Thursday. So that's what I'm seeing in the markets as of right now. With all of that being said, I hope you all have a great day. Remember to stay calm in the days ahead and do not make any irrational decisions. And with that, I'm curious to hear your thoughts in the comments below. Please leave a like on this video so more people will see it. And while you're down there, please consider subscribing. It's free and you can always change your mind. Thanks for watching, and hopefully I'll see you in the next video.